AI spending is exploding. Chips, cloud, data centers, power, cooling, everything. But Wall Street is starting to ask a harder question. Who is actually earning a return on all this spending? Today, we're separating the real AI infrastructure winners from the companies just writing bigger checks. AI is real. That does not mean every AI Capex dollar creates shareholder value. The last phase of the trade rewarded belief. The next phase rewards evidence. Show me the returns. Show me the margins. Show me the cash flow after the data center bills, the chips, the power contracts, and the financing costs. That is where this video is going. The market is not suddenly deciding AI is fake. That is the wrong read. Nvidia and semiconductor demand remain central because accelerator supply is still one of the biggest gates in the system. Broadcom and custom silicon matter because the second-order chip discussion is about who can lower cost per workload, not just who can buy the most GPUs. TSMC memory suppliers and networking vendors sit inside the same chain. But Oracle and other cloud and data center names are being judged differently now. Growth is exciting only if the spending burden does not eat the economics. Microsoft, Google/Alphabet, Meta, Amazon, and Oracle are committing major resources to AI infrastructure. That may be necessary. It may also pressure free cash flow. At the same time, power and grid constraints are becoming part of the investment thesis. You can have demand, software, and customers, and still run into transformers, interconnection queues, cooling capacity, and electrical capacity. This is why the AI universe needs 4 buckets. AI sellers sell the picks and shovels. AI spenders buy infrastructure to defend or grow their platforms. AI enablers control the physical bottlenecks. AI story stocks claim productivity gains, but still need proof. The mistake is treating every bucket like it has the same economics. This is where the Apex AI Capex scorecard comes in. First, revenue quality. Is AI revenue recurring, usage-based, backlog-based, or one-time hardware-driven? Backlog is not the same thing as profit. A large contract can still produce thin returns if the infrastructure cost is too high. Second, Capex intensity. How much spending is required to produce each dollar of incremental revenue? A company that needs massive new data center investment just to keep up may be growing and compressing returns at the same time. Third, free cash flow conversion. Accounting profit matters, but cash flow is the deal jacket. If profits are being consumed by servers, buildings, power commitments, and network build-out, investors need to know that. Fourth, debt and financing risk. Is growth self-funded, or is it balance sheet funded? That question matters more when rates are not free. Fifth, customer concentration. Is demand broad-based or dependent on a few mega customers? Sixth, bottleneck control. Does the company control chips, power, real estate, network capacity, or software distribution? Follow the bottleneck, not just the headline. Seventh, pricing power. Can the company raise prices, or is it absorbing higher infrastructure costs to stay competitive? The scorecard is not a price target. It is a way to separate verified facts, market sentiment, and Apex interpretation before the narrative takes over. For Nvidia-type winners, the question is not simply, is demand strong? The better question is how much future strength is already priced in. That distinction matters because great companies can become risky investments when expectations outrun the evidence. For cloud companies, the issue is whether AI workloads improve margins or force permanent higher Capex. If AI makes cloud platforms more valuable and customers pay for that value, the math can work. If competition forces platforms to absorb the cost, revenue growth can look better than shareholder returns. For infrastructure and power stocks, the opportunity may be real, but valuation and regulation matter. Utilities and grid equipment companies can benefit from demand, but regulated returns, project delays, permitting, and capital needs can change the story. Cooling, electrical contractors, data center suppliers, networking, and memory may all benefit, but not every supplier has the same pricing power. Retail investors also need to look at hidden concentration. Your AI exposure may be much larger than your ticker list suggests. If you own S&P 500 funds, NASDAQ funds, mega-cap tech, semiconductor ETFs, or growth funds, you may already own a large AI factor. Before adding another AI stock, check what you already own. The bull case is straightforward. AI demand remains durable. Infrastructure bottlenecks create pricing power. AI products turn into real productivity gains. Hardware, cloud, and power companies see multi-year growth. In that world, the winners are not only the loudest AI brands, they are the companies that convert scarcity into cash flow. The base case is more selective. AI remains real, but returns become uneven. The best companies keep winning, while overextended names get punished. Investors rotate toward proven cash flow, bottleneck control, and management teams that can explain the payback period. The bear case is not that AI disappears. The bear case is that Capex runs ahead of monetization. AI workloads become less profitable than expected. Competition compresses cloud and hardware margins. Highly valued names re-rate lower because the market paid for a clean earnings ramp and got a messy investment cycle instead. This is why the phrase "show me phase" matters. It does not require cynicism, it requires discipline. Nvidia can still be strategically central. Oracle can still grow AI cloud demand. Microsoft, Alphabet, Meta, and Amazon can still build important platforms. Broadcom, TSMC, memory, networking, power, and cooling can still matter. But the market will increasingly ask each company to prove whether its AI exposure produces returns after capital intensity, financing risk, and competition. Here's what investors may be missing. First, the AI trade is becoming a return on capital trade. It is not enough to say a company is exposed to AI. The question is what it earns on that exposure. Second, the best stock may not be the loudest AI brand. Sometimes the better business is the supplier that owns a scarce constraint. Third, the bottleneck may shift. In one period it is chips. In another it is power, cooling, memory, networking, or grid access. The market will chase the bottleneck, and then eventually ask who can defend margins when that bottleneck changes. Fourth, AI spending can be bullish for vendors and bearish for overextended spenders at the same time. A seller can report demand strength while a buyer absorbs a cash flow drag. Fifth, index investors are not neutral. Because mega-cap technology dominates broad market benchmarks, passive investors may already be making an AI bet. That is not automatically bad. It just needs to be visible. The next phase of AI investing is not about believing in AI. It is about proving who earns the cash flow. If you want the AI Capex scorecard we'll use to track Nvidia, Oracle, hyperscalers, power infrastructure, and the next wave of AI winners, subscribe to the Apex Wealth AI newsletter. It is built for investors who want the signal without the hype. Use the scorecard before you chase the next headline. Separate verified facts from market sentiment. Then decide whether the business is actually converting AI demand into durable free cash flow. This content is for educational and informational purposes only. It is not financial advice and is not a recommendation to buy, sell, or hold any security. Always do your own research and consider speaking with a qualified professional before making financial decisions.